Hello and welcome to DealPen's Capital Markets Analysis Series. This is our third video cast and we appreciate you joining us and watching this video. Today's topic is we are going to be discussing the funding and financing of later stage companies, and in particular companies that have the ability to take on debt. So let's have a discussion regarding what is currently happening in the marketplace for the companies that, if they need to rework their existing banking relationships, or they may be to a point in their corporate life cycle where they have the ability to go out and meet with bank funding sources. This is a timely topic for us because we've currently been having some conversations in the marketplace, and it will give you a real-time experience, on what you can be expecting if you're heading to the bank, or you have clients or people you know that are going to be going to the bank for financing. In today's market, you need to be prepared and have everything in place. And for some people watching this video cast, my apologies, this may be stating the obvious. When it comes to banks and commercial banks, the Wells Fargos, the Credit Suisses, the major U.S. banks, Citibank, and so forth, you have always needed a certain level of preparation to walk into the door. Companies had the opportunity back in the mid-2000s to be a little more laid back in their approaches to the banks because credit was freely available, and they were able to get in the door and to often get deals done with much lesser documentation than is required today. Now, that has become very obvious in the world of mortgages. On a personal level, if you've gone out and you've gotten a mortgage in 2004, 2005, even up through 2007, and you've recently refinanced or recently gotten a mortgage, you can see that night and day difference from nearly having just to provide your credit score and a recent couple of stubs to today you pretty much have to give the entire background of the past tax returns and every possible piece to your financial history. So keep that in mind even when you're thinking about your own business and the experiences that you'll be facing when you go to a major lender, whether it's an SBA loan for a couple $1,000,000, even a few $100,000. Those have always been pretty regimented in their documentation. Or if you're going out and seeking $50, $100, $150 million lines of credit and debt financings that may be syndicated. The conversations that we have had and we're hearing in the marketplace is that things need to be in a package with a bow on it. Everything needs to be well thought out. And on top of it, an interesting piece to the equation today is that banks are much more interested in the personal relationships with the executives on the other side of the team. They want to, they are taking a much more comprehensive approach to their underwriting. Their documentation of these loans is going well beyond what is on paper, what assets are worth. It's going into human capital. Who are these people that make up the executive teams? Do they have any weaknesses? Are there weaknesses within their financial reporting mechanisms? And you're going to be getting a lot more of those questions. And so you should be well advised to prepare that and have comprehensive answers, and not just made up answers, but documentation of your internal reporting mechanisms and your processes, and in financial projections that you are well supported with functionality in your Excel sheets that the banks can go and do their own due diligence and help get a really understanding of not only your business, but can truly stress test these assumptions in the Excel sheets. Because more than ever, they're going to do it. And to the extent that you can spoon feed this information to them, the better off you are going to be. And spoon feed is not the right analogy, but give it to them all in one package and ready to go. And hand holding would be a little bit better from that analogy, where they can you can demonstrate to them an Excel sheet and a working knowledge of your marketplace and your opportunities. And yes, you have optimistics insights on when you finance your project and how much ethanol or biofuels or widgets that you're going to be manufacturing. But you can also demonstrate to them and guide them through how to utilize your financial reporting mechanisms, your Excel sheets, and to drive their own assumptions. So if they want to change the price of the inputs, they can easily do so. So that can help them out tremendously in the underwriting process. Keep in mind that the banks do have capital available today. They do, and they want to lend. However, they have internal pressures from their managers on their underwriting procedures, and they have and even more pressures from the regulators to make sure that everything is well documented and ratios are well within their confines. So banks want to lend. They're out there. They're looking for good deals. However, things need to be much tighter than they have in the past. And so keep that in mind when you're walking into a banking relationship. For mature companies that are looking for other tranches within the capital stack, there is the availability out in the marketplace. You are going to have to do a little more homework and to keep up on the trends, because as we're speaking, there is a lot of changes going on in the high yield market. There are glimpses and insights where covenants are becoming less restrictive, and so that what I'm seeing today is that is changing quite a bit, and the ability to take on some sub and mezz financing. There's some of the private equity groups or some of the sources of capital, the institutional sources of capital that can become a little more creative in your capital structure. But once again, you're going to have to go out there and do homework, especially within your industry, to understand who those people are and people that have the ability to analyze your industry and understand your current capital needs and future potential needs. Because now that I'm thinking about it, another aspect of what lenders are looking for today is that they want to work with you on a 5 to 10 year note, maybe a 10-year AM. But they truly want to be paid off. They're not going to be banking into their equations today like they were in the past, the ability to refinance. However, they are starting to refinance more projects, but they're not baking that in on their front-end assessments. These projects, or the companies that are seeking the financing, need to stand on their own two legs through the life cycle of the loan package that would be brought to bear. So this concludes our third installment of our video series. Hopefully that gives a few insights. As always, we welcome your feedback to these video series, and we welcome follow-up questions to the extent that we can be helpful. But please stay tuned as we continue to cover more topics to provide you with insights into what we are seeing currently in the capital markets. Thank you.